SOFI's earnings are less than 24 hours away, and there has been a lot of commotion around the stock and its price action. Now, over the last 2 weeks, the stock finds itself up over 25%. Now, I definitely want to talk about the positives, some of the assumptions that were made that some people may actually find a stretch, and one particular thing that made me a little bit nervous just before earnings. So, of course, things can definitely be a bed of roses. Everything is actually fine, and I'm just overly concerned, and we skyrocket to $15 after earnings, and that'd be great. But as always, potential is a dangerous word, so let's dive in. Now, I think we should begin with the reason why at one point on Thursday, SOFI found itself up over 8%. You see, on Wednesday, after market close, Lending Club actually released pretty good earnings, and that actually poured fuel on the SOFI rally. And I think many people in the market tend to see Lending Club as this proxy to SOFI, and they think that the two of them are actually pretty similar companies. However, I do have to say I honestly disagree. I think Lending Club is a good indication of SOFI's personal loan business segment, but to say that they are comparable companies to me is a little bit of a stretch. They don't have a financial services business growing at over 80% year over year. They are not vertically integrated, and they don't really have a tech platform to speak of. But with that said, let's take a look at why it caused SOFI to basically skyrocket. And so the first thing, I think it really comes down to loan sales. Lending Club are seeing partner banks come back to the loan market, and during their earnings call, they actually said that in the last week, they actually made a $400 million sale to a new loan partner. So that in and of itself is impressive. And the projection of being able to sell over $1 billion in loans in the next 12 months actually bodes well for SOFI's future as well. So you can see I actually read a lot of articles on X and things like that says that, Lending Club has done well, so SOFI will definitely do well as well because their loans are of similar quality. And I think to a certain extent, you can extrapolate that relationship there. But there's one caveat over here, which is that I think SOFI's loans are of higher quality than Lending Club. Now, if you take a look with me, Lending Club actually tells us that the average Lending Club customer has a FICO score in the 700 plus range with an average salary of about $100,000. And I think we have covered previously that the average FICO score of a SOFI customer is about 747, which is pretty close to 750. And the average, income for a SOFI customer is in the $150,000 to $160,000 range. If anyone remembers where this $150,000 to $160,000 number come from, right? Please drop me the link below because I can't really, find the article that I actually referenced previously. So, apart from that, if you take a look at the national average FICO score, when I go to the FICO website, it actually tells me that the average FICO score of a US citizen is 717. So when I compare the FICO score of the average customer of both companies, what it tells me is that the average Lending Club customer falls below the national average, and the average SOFI customer is way above the national average. And so to say these two companies originate similar quality loans is quite far off the mark to me. And so if I think about it objectively, because SOFI's loans are of higher quality, what it means is that yes, they will do well, and in fact, to me, I think that they will do even better than what Lending Club has done and perhaps command an even larger gain on sale margin. And I think the second thing that I want to point out is this chart over here. Now, the main thing I want to say is that, in general, net charge-off rates are inflecting downwards for Lending Club, and that is definitely a good sign for SOFI as well. Net charge-offs for Lending Club fell from 6.2% in the prior quarter to 5.4% in this latest quarter. And in fact, Dan Dollar from Mizuho basically raised his price target for SOFI to $14 all the way from $12 previously. And the trend of this net charge-off inflecting downwards actually played a part in his thesis. But I wanted to point out something interesting here, because in a few of my last videos, I addressed some of the bear cases against SOFI when it comes to accounting and stuff like that and the quality of their loans. But if you take a look at the loan vintage of both SOFI and Lending Club, now for the 2022 loan vintage, as of June of 2024, SOFI were at 5.02 accumulative net losses, whereas Lending Club was at 7.2% accumulative net losses. But if you take a look with me over here, the net accumulative losses for the 2023 loan vintage for Lending Club is at around the 3.5% as of June of last year. But if you take a look at the various cohorts of loans originated by SOFI in the first quarter of 2023, second quarter of 2023, and the third quarter of 2023, you realize that the average here is around around 2.5%. Now, I don't know about you, but when I look at these numbers, it seems quite hard to fathom to me that a company like KBW can actually say that, we're going to take a long lending club and short SOFI position. I think that is way off the mark if you ask me. I think if you look at the loans that lending club are originating, it's not that they're bad quality loans and its performance is not like terrible, but I think if you compare it to SOFI, it's quite easy to say that SOFI's loans are of better quality. And so if you're going to say long lending club, I would say that, equally you have to long SOFI, and to say that, I'm going to long lending club, look at SOFI's qualities of loans and say that we're going to short SOFI. To me, at least, I think it doesn't make any sense. But that's my perspective, which is why I'm invested in SOFI and not in Lending Club. Now, in other news, I actually like to watch people do deep dives into company. I'm the type to actually watch through the whole 3 hours of how people actually build out their financial models for company. And while I think that kind of fuels my inner nerd, I do understand that as retail investors, sometimes doing a solid DD doesn't actually require that level of complexity. And I do think that this thought process basically comes largely from Warren Buffett. I can't find the actual quote right now, but the basic premise is simple, is that you don't need complicated math to prove a good business model. And if you're investing in a crap business, basically the complicated math is just going to hide the mess. And I think his point is that many times, back of the napkin math is more than enough for us to understand whether or not this company is a viable investment opportunity. And I think, for us as retail investors, it's important to strike a balance between running all these complex models and, going to the other extreme where you just take management's words at face value. And so I think when it comes to SOFI and the community around it, people like Tanner and data-driven investing, Chris, gives us a very good balance. And what I like to do, even before making all these videos, is to actually come up with my own projections before the SOFI weekly that precedes SOFI's earnings, so I know my own analysis is as unbiased as possible, and compare the thought process between how I actually come up to my numbers and how they actually come up with their numbers. So recently I realized Chris of Data Driven Investing basically released his SOFI's earnings as well, and I just wanted to see how similar or different our analysis are. So basically I want to start with SOFI's main growth driver, member growth. Now when it comes to member growth, Chris in Data Driven Investing, basically he expects 675,000 new members to be added compared to my estimate of 690,000. Now when it comes to member growth, I think we largely have the same assumptions, with the Taylor Swift quarter from last year making comps pretty hard. And I think one thing Chris pointed out, in addition to whatever I've said previously, is that with SOFI ramping up their lending, they're actually spending more on marketing, and that could actually drive new members. And with that said, I do have to say I'm kind of surprised with his estimate of around 675,000 members. I already thought my number was quite conservative. And the thing is, if I actually put his numbers into my own model, it works out to be about a 35.8% growth year over year versus my 36% growth. So, actually the difference isn't as big as I thought it was. So it's quite a negligible difference over here. Now, in my head, I can't really see how we get customer count to start with a 7 this quarter. I think that is more of a next quarter projection, because I know, the NFL season has started, and maybe because I don't live in the US and I may just underestimate the effects of the NFL season starting. And if so, I couldn't be more happy to be wrong. But I think as an investor in SOFI, I think it's always conflicting, because management gives us this pretty aggressive estimate in some cases, and yet at the same time, we know them to be conservative. And so Anthony Noto has said that they hope to add between 800,000 to 1 million members per quarter consistently. So for me, I'm sure we'll hit the 700,000 plus members soon. I'm just not sure whether or not it's this quarter, because I think we will eventually hit Noto's projection towards the second half of 2025. Now, if you take a look at Data-Driven Investing's projection for lending revenue, I think the underlying assumption here is the same, which is that lending revenue is not going to come in at 95% of 2023's level. With mortgage rates rising and this just being the start of the rate cut cycles, I think the assumption here is that we are really in the initial ramp, and the bigger boost to lending is still to come. But of course, loan sales have already started to come in. I think we have seen that over the last couple of quarters with SOFI. SOFI has actually already sold over $4.5 billion in loans in the last 3 quarters, and I expect us to see more of the same. I do just want to remind us, however, that while Galileo and Technisys has been at the forefront for SOFI, and that these two companies have actually been, something that investors are talking about, I think we should not forget that SOFI actually also purchased Wyndham Capital Mortgage last year, and I think that will catch many people off guard, because I think the narrative around SOFI is constantly changing. When I first started looking at the company, they were called the student loan company. And then over time, as student loans dried up, they are now known as the personal loans company. And I think I wouldn't be surprised to actually see them start capturing, mortgage refinancing and mortgage loans. And the next thing people may end up calling them a mortgage company instead. And I think in terms of the tech platform, I think Data-Driven Investing and I are both frustrated at the lack of execution. And I think he takes the words right out of my mouth here when he says that there should be no excuses of long sales cycles and slowly ramping revenue. I think we do need to see revenue come in past the $100 million mark at the very least. I'm not going to dive too deep into his breakdown because you're going to have to read it for yourself. It's really, really great stuff. And I'm going to put the link to his article down below. But in terms of lending and tech, I think we're really close in expectations. And I do think that the success of the tech platform is what will determine the multiple that investors ultimately apply onto SOFI as a business, as well as analyzing their total addressable market going beyond 2026. And I'm just saying this without any calculations. It's something that I just thought of and I may definitely look to model out in future. But I do think with the tech platform underperforming, we might only hit the first level of Anthony Noto's PSUs in 2026. However, if it does perform, I wouldn't be surprised to see it at least reach the second level of his PSU, which is around $35. Now, in addition to all of these things, Chris actually does go a little bit deeper when it comes to originations of loans and deposits and things like that. And if these are things that you actually want me to cover in my future projections, do let me know down in the comment below. And while you're at it, don't forget to hit the like and subscribe button. Thank you for your time, and back to the video. Now, I want to spend some time talking about the most exciting aspect of SOFI's business to me, which is their financial services segment. I think when it comes to financial services, Chris and I are both pretty close on our estimates. I think he uses management's guidance of about 80% year-over-year growth. But when I actually read the previous earnings transcript, management actually did say more than 80%, which is why I'm using 81%. And I'm someone who is pretty much, against taking management at their word because they can actually pull any number out of thin air just to make the investors happy. And I want to talk through the thought process behind these numbers and link them to the fundamentals of the company. So the thought process behind this is actually quite simple. How can SOFI grow financial services revenue so quickly? Very simply, if you break it down, there are basically three ways that they can do this. They actually can do this by increasing the number of customers that use their products, which is customer growth. They can increase the number of products each customer uses, which means it is the products per member. And each product can basically be generating them more revenue, which is revenue per product. And so if you think about this with me, I think if you look at the trends, the revenue per product growth has been normalizing in the last 2 quarters, coming in around the 30% mark. And that is what I'm expecting this time around, with a 29% year-over-year growth. That puts revenue per product at $17.27. So if each product actually generates you $17.27, in order to hit the 81% growth rate, $240 million in revenue, you'll need to have 12.39 million products. Now, of course, each member, possibly uses more than one product. And if you take my estimate of 688,000 new members added this quarter, the total member count in Q3 will be 9.46 million, and that works out to be about 1.31 financial services products per member. Now, this is the part you actually need to pay close attention to so you can decide whether or not you are comfortable with the assumption. Historically, financial services products per member has been within the 1.25 to 1.27 range. Now, why am I comfortable with 1.31 financial services products per member? Very simply, there are 2 reasons. Using this 1.31 number, what I actually get is a 40% growth rate year over year for the total number of financial services product, which is well within range historically of what they have been doing. And the second reason is that if you take a look at Anthony Noto's comments back in June of 2023, he actually said that in the next 12 to 18 months, which means all the way up to December of this year, expect SOFI's product per member to stay around 1.5. This is combining both financial services and lending. But this is due to a focus on member growth. But the last part of the quote is actually the most important. He says the bigger we make our member base, the bigger we'll make our products adopted by that member base over time. I do expect that at some point we'll actually see SOFI drive an increased adoption of their product among their member base, which is basically the key assumption behind my 1.31 financial services products per member. And to me, that is a step in the direction that Anthony Noto has pointed us to previously. Now, why am I bringing this up? Because I want to show you some, other possible scenarios. Because if you look at this and say that, hey, I actually feel uncomfortable with the 1.31 financial services products per member, it's a big jump from there to 1.25. Well, fair enough. Perhaps you can see another way where member growth or revenue per product is the one that actually takes us there. So basically how we actually do this is that you take the total number of members, you multiply by the number of product each member uses to get the total products that SOFI has. And then you take these total products, multiply it by the revenue that each product makes to get the total financial services revenue. So if you use, let's say, 750,000 members added this current quarter, which is a 36.8% growth year over year, at a 1.25 product per member, right, you actually need to generate around $17.98 of revenue per product in order for you to hit the management's target of 214 million. Of course, if you use my initial estimate of $17.27 of revenue per product, that will actually only get you to $204 million of financial services revenue, which, by the way, is still a 73% growth, which is quite impressive itself, but it's not quite the 80% that management is guiding for. But the thing is, if you use $17.98, are you able to justify the increase in revenue per product going all the way from 30% back up to 35%? And so the only reason why I'm not using this calculation, and I'm not saying that this calculation is wrong, is because management hasn't really spoken about generating more revenue per product, but their focus has been on getting more people to use their product or increasing adoption of their product among their current members. I think at the end of the day, we have to realize that whatever company we invest in, SOFI is one of them, they are all multi-billion dollar businesses. And if they guide for 80% growth, I think because they have so many moving parts and there are many, many levers they can actually pull to get there, I think what we're doing in our valuation and projection is just to find out if it's possible for management to achieve their goal and not to pinpoint the exact method that they will use. I think it's like one of these mazes that we play as a kid, right? There may be more than one way to actually reach the end, and our job as investors is to find out whether or not it's possible to even reach the end in the first place. But come Tuesday, as long as they hit their guidance of 80% and more financial services revenue growth, if they don't do this by driving, more product adoption, but by growing members or increasing revenue per product, I'm not going to be unhappy, right? I'll just take it as more info to use in my next projection going forward. And all this to say that, you can see that this 80% number that the management has given to us is not a stretch. SOFI only has to achieve marginal efficiencies within the business for them to drive exponential growth in this segment. So either by, increasing adoption of the product by 0.05 per member, or increasing revenue per product by 4%. And these are just small tweaks that we can actually comprehend and understand it as we drive it down to the fundamentals of the business. So going into earnings, apart from this, I'm hoping to hear management shed some light on things like credit cards, because Anthony Noto did say in the previous earnings that this portion of the business can be bigger than the whole business itself, right? So because of that, I think it's important for us to actually know how the progress in this segment is working and where they are with that. And I do want to understand how the Fortress deal actually affects their profitability, because correct me if I'm wrong, I think this is actually counted under their financial services revenue. So I'm thinking, do we model this out only in Q4, or is this spread out over a couple of quarters going into 2025? Now, right at the start, I said that there's one tiny thing that got me a little bit nervy about SOFI going into its earnings. And well, I'm aware it could just be a nothing burger. Okay, and I'm not trying to actually scare anybody. I'm just, wanting to put it out there because I might be overly jaded. You see, the thing is, I know that institutions have been accumulating, and in fact, institutional ownership for SOFI has increased from about, I think, 330 million a year ago to about 487 million shares currently. So that is about a 45% institutional ownership. Now, there's a trend with companies I follow like Tesla and Palantir that as institutions come in, the stock price tend to follow because, this actually creates a new floor to the stock price. And so you add on to that a full year of profitability, it looks like, $15 is definitely incoming, or so it seems lah. Now, in fact, I actually also saw a post on X. If I can find it, I will definitely put it up here. But at the time of recording, I can't really find it. But I basically saw this post that says that, we're actually testing this upper band of resistance that goes all the way back to 2021. And if we break that upper band of resistance, we might have our Palantir moment. So I'm going to see if I can find that for you and put it in. But I have to say, back in Wednesday of last week when SOFI actually pulled back, I was quite relieved. And on Thursday, when we rallied based on Lending Club's earnings, that made me feel a little bit uncomfortable. because I think I'm just worried, in general, what people are already pricing in. And internally, I'm quite conflicted because on one hand, I know SOFI is super undervalued. In fact, I think in my opinion, it's probably the most undervalued fintech in the US markets. But on the other hand, I had actually hoped for, SOFI's price to bob around the low to mid $10 range leading up into earnings so that the RSI can cool off, so that we can actually rubber band up on earnings. Because if you take a look over here, we have been in overbought territory for quite a while, and it feels like at this point, SOFI needs to deliver a more than perfect earnings quarter to keep this momentum going. And I think the last time the RSI for SOFI stayed so elevated in the overbought territory was back in December of last year for about 2 to 3 weeks. So of course, when I look at Palantir, the RSI was overbought for more than a month between May and June of last year. So I'm definitely not saying, there's definitely going to be a drop in the coming days ahead. But I'm just saying that this has gotten me a little bit nervy going into earnings. And if any technical analysis pro, wants to ease my nerves, please go ahead and do so. Because for me, the way I use technical analysis is to find entry points into the companies that I want to invest in and to view options. So I am by no means an expert when it comes to technical analysis. So I could be definitely worried over nothing, right? But hopefully, I'll be making my preliminary earnings review video with SOFI sitting pretty at the $12 to $13 range. And that should be out on Thursday. And with that, I'll see you in the next one.